Hey guys, it's December 27th, and I want to do a quick video that discusses how I do my top-down analysis and specifically how I use Keltner channels when I am trying to decide whether or not I want to take a trade or exit a trade. What I have here is the volume leaders scanner screen, and this is from September 15th. And I'm using this just to illustrate an example that worked out nicely. And what you can see here is this was an OPEX day. There are a lot of highly ranked trades here, and there was a lot to go through on this day. The ticker I'm going to talk about, though, is Walmart. And when I was going through this and scanning through everything to see if there were any good setups, this one jumped out at me. It jumped out because it was over $1 billion. And it was the second largest trade in the history of the ticker, with the largest being back in 2005. So, quick math, 18 years ago. Long time. So this stood out to me more than some of the others. There are a lot of number ones and a lot of number twos here, but this one was so rare. 18 years ago was the last time it was larger. It was over $1 billion, which is kind of a magic number that I look for. $1 billion in Apple is fairly common. $1 billion in Microsoft is fairly common. $1 billion in Walmart is, even as big of a company as they are, is quite rare. So this one jumped out at me, and I started to do some research. So the first thing that I did was click this link, and I pulled up a chart which shows me the entire history going back to 2005. And I'm not going to show you that. It's a little bit too much to show, but it just illustrates that we're at all-time high. We were at all-time highs basically at the time that this trade came in, and everything below it was, or the only thing below was the number one, which happened a long time ago when price was a lot lower. And then I pulled up a chart of just the last year, just to get a general sense of where we were in the context of the year. And I have a chart with the three largest trades shown here, going back to the beginning of 2023. And obviously the number two here is right here at the top. Number 23, which came in after a nice little rally here, and number 22, which came in right near the low. So as we often see, we have disproportionately large trades arriving at inflection points and important turns. One here at the low, one here at an intermediate high, and price kind of chopped there for a while, maybe a month and a half, and then continued up further. This one, as I've mentioned previously, just really stood out. So when I look at a chart like this, the first thing I want to do is ensure that these trades are at obvious potential turning points, and this certainly fit. Then I looked at that day's action, and I saw that we had a little little sell-off here towards the end of the day, and then we had these three trades all coming together. Now, they're hard to see here because there's a lot going on in this particular spot, but there are three ranked trades here, not just the number two. There's also number 83 and then number 90. So just more evidence to support the fact or the notion that there is potential for a reversal here, that this is in some way telegraphing that a turn is near. So after this, that's when I switch over and I start looking at my charting platform. And I use thinkorswim for a lot of this stuff. And one of the things I use is the multi-time frame Keltner channels. So this is a script that you can go and download. Someone was kind enough to share it for free. If you just Google MTF Keltner, MTF standing for multi-time frame Keltner, it'll take you to this screen, and it'll give you this little script here, which you can copy and paste into your platform and as a study. And then once it's there, you can configure multiple studies in the same chart. You can have different intervals: day, week, month, quarter, year, 4 hour, 2 hour, 1 hour, whatever it is that you like. And I have about 5 or 6 of them on there. And this is where I'm going to pause and switch over to thinkorswim and start talking about how I interpret those charts with the multi-time frame Keltners on them. Okay, so now we're looking at thinkorswim, and I have this zoomed out to the weekly level, and I'm showing every week. This goes back to the year 2000. This is just something I do at the very beginning to ensure that or just to see where we are in the broadest context, um, we can see obviously that at the time these trades came in, price was sitting right here at or just maybe a hair below all-time highs. And from there, I zoom in a little bit further, and we look at the last 3 years in the weekly time frame. And if we go to September 18th here, which is just after the 15th, we can see that the weekly close of the prior week was right here at this pink dashed line. This pink dashed line is the monthly Keltner. The red dashed line is the weekly Keltner, and you can configure these however you like. But we can see that the weekly was just about to converge with the monthly when this candle painted and when that number 2 trade came in. And when they come in, when these trades come in that are disproportionately large and coincide with an important Keltner level, such as the weekly or the monthly, that is additional evidence to suggest that they are accumulating or distributing. If it's near the weekly or monthly top, or daily, it could be daily, it could be 4 hour. The time frames vary, but if it's at or right at one of these boundaries, that suggests to me that that they have met their target and that they're looking to, in this case, sell into this resistance level. So if we go even a little bit further, we can see that on the 15th, here we are, and we have the confluence of the monthly in pink, the weekly in red, and the daily in blue. So all these levels are kind of meeting at the same point, and price is, and the trades came in as price was approaching that zone. Now institutions don't always, tap the very tops and the very bottoms. They tend to get in just before the tops, or just before the bottoms, and get out just before the tops. So they can't get their fills at the absolute highs and the absolute lows. They have to get their fills where there's liquidity, and so they get their trades filled, and then price usually continues just a little bit further in the direction of the trend before exhausting and reversing. And so this told me that potential for that to happen was high enough, worth taking a trade. Now, price had been in such a long, sustained uptrend that timing a reversal can be difficult. You never quite know how long it's going to take, if even it happens. So I wanted to take a trade that would give myself a little bit of time. I didn't go in and buy puts the second that I saw the trade came in. I didn't want to short shares. I decided to sell a bearish call spread, which would give me some time for price to exhaust and meander and chop around and whatever it needed to do. Now, when that number 2 trade came in, you don't know if that's going to be the only trade. You don't know how much inventory they have and how much they need to distribute and how long that might take. So I wanted to put a trade on that gave me enough time for price to resolve in the direction that I was hoping for, and limit my risk in the event that I was wrong. So as you can see, price did begin to resolve lower. Okay, so flipping back to volume leaders, we can see the number 2 and the 83 and the 90 all came in together here, and we got a really quick move lower. And that told me right off the bat that my thesis was likely correct, that they were, in fact, selling. Price was going to resolve lower, which I had hoped for and planned on. And so at that point in time, I knew, okay, well, I probably got the direction right. Now I just have to manage the trade and decide how long to hold it and what I'm going to do with it. So price came down here. And then you can see it retraced right back up to the level the trade came in. This is fairly normal behavior. So you can trade for that first move and then get out and maybe try and restrike, or you can play the long game and hold on to it and just know that if it gets back above this level where this print is, that you have to cut it or manage it in some way, manage your risk, and ensure that you don't let this thing run against you. But this is pretty common to get a move, an initiation move, and then a retrace back to the level at which the print arrived, which is exactly what happened here. And then price got back to that level and was rejected and headed back lower, made another lower low. Now, I didn't hold it all the way down for this big move here. I mean, it would have been nice. I don't remember how long I held it, but somewhere down in this area, I decided, I was satisfied with the move and moved on to the next thing. But you can see that price came down here, and then it retraced all the way back up and eventually made a new high. And if we flip back to the Thinkorswim chart, you can see that price got back to the same monthly Keltner channel before it was rejected once again. So I'm going to flip back to that now. And back to Thinkorswim, we can see that we got this move lower, and look, it stopped right here at the weekly bottom. So had I been in it for that move, and had I seen that rejection, immediate rejection, when it got to the weekly bottom, that would have been a good signal for me to get out. Now, I had gotten out before then. I got what I came for and moved on to something else. But but these Keltner channels are very useful in determining areas where institutions might change course. Not every ticker stays within every Keltner the way you'd expect. These are just sort of boundaries that are guideposts, if you will. Price could have easily just broken this weekly bottom and headed further south, but it didn't. It stopped here, so this would have been a good place for me to get out if I was still in. But you can see that price retraced all the way back up, got back up again to the monthly Keltner top, where the daily and the weekly were all converging once more in the same spot. It poked a little bit higher, rejected, and then gapped down. And I think this was an earnings gap here. But the monthly Keltner, one of the things that gave me confidence to take the short in the first place was that this monthly Keltner held several times. Now, at the time, we were only looking at data from 9/15 and before, but this I thought would hold. It approached here, it held, and the weekly also held here and here. So this was something that I was fairly confident would hold. If we go back to the weekly chart, it becomes even more apparent. We've got a hold here, 1, 2, another one here. We've got a little spike up here back in January, which held. We got another trip here, April 18th of last year of 2022, which held, immediate rejection. We've got a rejection here at the monthly level, going back to August 23rd. So we can just see that this is a level that price is respecting. So each visit was met with the same fate. Rejects on the monthly, bounces on the weekly. And it stayed within the weekly bounce here for a bit, got to the monthly and rejected. Big sell, came back up, rejected here at the monthly, saved here at the weekly, and then the weekly just kind of rode the weekly Keltner up for a while until the weekly met the monthly, at which point we got another sell. So the Keltner channels are useful in determining where institutions might change course. They don't always hold, and there are no guarantees, but they do measure or help measure when price has gotten a little bit too far away from the mean. So on a given time frame, once it hits the Keltner top, it's I think 2 ATRs away from the mean, and same thing at the bottom. And that is often enough to get institutions to get out of their positions, or likewise to get in their positions. They got in at the weekly bottom here. They got in the weekly bottom here. Weekly bottom here. Weekly bottom over and over and over again, all through here. So these weekly and monthly levels are very valuable. I like them. If they sometimes do let you down, just like any other methodology you might employ, but If price gets a little too far ahead of the or outside the bounds of this Keltner and closes above and stays above, well, then you have to reevaluate. But in each of these cases, when it got above, it quickly came back in. And sometimes it didn't even get above, or maybe just poked up and then quickly rejected. So that's it. That's how I use Keltner channels. It's just one way to overlay the data that Volume Leaders provides with some version of technical analysis. And there are lots and lots and lots of different methodologies out there. There's not any one that's necessarily superior to the others. But what is important is that you can look at the positioning that institutions take, and if you can find confluence with another methodology, it gives you additional confidence to take a trade or get out of a trade. Because at the end of the day, you want to follow the money. You want to do what they're doing. And so if we can see that they're doing something at a level or at a boundary that is meaningful, then we can sometimes infer what we think will come next. And after that, it's just about managing risk and knowing your targets and deciding when to get in, when to get out, when you've had enough. So that's it, guys. That's my little speech on Keltner channels. I do this. This is part of my normal checklist. Anytime a big trade comes in, I first look at it on Volume Leaders. I look at the volume profile. I come over here to Thinkorswim, and I start looking at the Keltners, and I decide if it's worth pursuing or not. There are plenty of times where it's not worth pursuing, when a big trade comes in the middle of nowhere and you can't make any sense out of it. But when I see a big trade come in at a meaningful zone, the more data points I can get to align, the better I feel about a trade. And then after that, it's just managing the trades. So I think I've rambled on long enough. Thanks for listening, and let me know if you have questions. Thanks, guys.